Welcome to Alpha Unchained, episode 5. Today we're going to talk to Paisley Nardini, head of multi-asset solutions and lead portfolio manager at T12 from Simplify Asset Management, and my colleague Nate Mozakowski. Again, this is not an investment advice, and the past performance does not guarantee future results. Please consult with your financial advisor before making any investment decisions. So Paisley, welcome back. I'm excited to talk about T12. For those of you that joined us, T12 is a private investment fund seeking to deliver a high monthly income through a diversified portfolio of alternative income generation strategies. And we started this fund in partnership with Simplify Asset Management. We are now past our first quarter for the fund, which was Q3. Super exciting results. So Paisley, why don't you talk about the T12 fund, the strategy on the T12 fund, given the results for the Q3, which was the first quarter for T12, were fantastic. We met our target objective of 12% annualized return before fees and expenses, with a net distribution rate of 2.778% of NAV. The quarterly total returns were 3.76% net of fees, annualized return of 15.92%. And since inception, the annualized returns were 18.29. What a fantastic quarter. So let's talk about that, Paisley. What was taking shape last quarter? What were the rebalancing activity? And how do you sort of really explain the performance of T12 looking back at the data?
Yeah, well, happy to be here again. Thanks for having me. And I would say, not to pat ourselves on the back, but I think you're absolutely correct in that last quarter, which was, again, the first quarter, the full quarter anyway, that T12 was live. I think we far exceeded expectations. And just to provide a little bit more detail on what I mean by that, of course, the target objective of T12 is a target 12% distribution. So we had no concerns, given the building blocks that we used in this strategy, that we would meet that core objective. I think what oftentimes is the case is anytime that you're reaching for a certain objective, it usually means you have to sacrifice on something. And typically in a yield-focused strategy, that can mean you're sacrificing on return. And T12 delivered from, and at least in my perspective, not only that 12% target distribution at the top, but really attractive total return and appreciation for long-term growth. And I can talk a little bit about, of course, how we did that, but I do think it's also important just to set the stage again on what gap the strategy serves within a broader portfolio. And the way I think about it as an investor, you're typically thinking about stocks and bonds as your two levers that you can pull. And you know that when you reach for kind of that equity beta or that upside risk, you're usually sacrificing on stability or preservation of capital, and you're sacrificing on income. And then on the other end of the spectrum, when you're thinking about traditional bonds, you're thinking about more stability, preservation of capital. And right now, traditional bonds are giving you anywhere from 4 to 6%. And so what I would say for those that have higher income needs, the traditional bond category is not footing the bill. If you think about cash rates being around 4% right now, core bonds being around 4% as well, like why take on credit risk? Why take on duration risk if you can just sit in cash? So that's not incentivizing enough for investors. And then as you move out to that higher yielding space in bonds, which would be high yield credit, you can maybe get around 6% yield. Again, if you're taking on additional credit risk, duration risk outside of cash, I probably want to pick up more than 1 to 2% over cash. So still not incentivizing investors. And so that's really where T12 seeks to fill that void, is that target 12% distribution. That's more than double what core bonds are delivering. And so the question becomes, how can we also allow investors in T12 to participate in upside? And we've been in this raging bull market. And I think third quarter, to come back to your question, Manish, is third quarter, we saw equity markets continue to melt up, as we're calling them. So continued to move higher. And despite all the volatility that we saw in the second quarter, the third quarter was kind of status quo. A lot of people were anticipating high levels of volatility and more news on tariff and slowing global growth and the concerns around, cracks in the employment market and whether or not the Fed was going to start to cut rates. ultimately markets look past all of that noise, and volatility in both the bond and the stock market was exceptionally low during the quarter. And it was really a tailwind for asset classes. We saw most asset classes, bonds, stocks, alternatives, gold, of course, which we'll talk about in a moment here, continue to melt up higher. And so T12 was really well positioned, going back to how we've constructed this, because of its diversification. We had exposure to some of the more traditional sources. We had more unique sources of yield in equity income, and we'll talk about that in a moment. And then we had some diversifiers as well. We did introduce gold into the portfolio in mid-August, the timing of which was quite serendipitous. We did not have a crystal ball, but it worked out well.
Right.
And maybe just to talk about some of the change we made in the quarter is mid-August, we took a step back and said, what can we be doing more of for this strategy? And so we introduced some more upside potential in the form of positive convexity. Simplify has a strategy utilizing derivatives that we can look at gaining exposure to the large cap equity market, and then buying call options within that market as well. So when markets do move higher, we participate more. And then another way that we sought to add additional levers in the portfolio was through a gold strategy, which provides levered exposure to gold, so 1.5 times. And then also has an income overlay. And so you see the kind of multifaceted objective of some of these strategies where we are seeking to enhance the yield potential while also participating in the rip that we saw in gold. And so I would say, recapping the quarter in whole, really strong performance. Total returns were about 4.7%, which was more than double that of, say, the high yield credit market. But provided investors, again, that core objective, which is 12% distribution. So I'll pause there.
I mean, super positive, right? I mean, I think when we started the strategy, Paisley, as we were designing this fund with you and the team, our focus was really kind of come in and provide a value asset to fix the middle mile challenge, which is on the left side on the crypto rails, you have just pure treasury, and then on the right side, you really have the crypto assets, fairly volatile. And this fund really fits that need, right? I mean, so you're talking about 12% income distribution, which is really no joke. And it's just amazing in terms of what Q3 has resulted for the fund in terms of performance. Nate, from where you sit, and as you think about the distribution of the fund, how are you aligning yourself with the conversation, especially as the narrative is turning more towards gold? Clearly, gold has taken a beating over the last couple of days, but looking back, it was the right move by Paisley and team to introduce that asset.
Yeah, I don't. I will pat you on the back, Paisley. That was. I'm looking at the gold strategy, and there's 7 positions, and the other one, SPUC, the upside convexity position, I think is what you were referring to with the call strategy. But I will, you could say pat yourself on the back, or, I know you're not market timers, but man, was that amazing timing on those 2 strategies being added, which they have lower yield. So it was much more of a gains play there, I guess, but amazing timing, even though you're not market timers. It's kind of funny. I'm looking at on my X feed, another person I follow, Ottavio Costa. He put out a chart today. The U.S. national debt reaches 38 trillion. No, this is not a chart of gold. And so it's, I don't know. I'd be curious in your opinion, like, does gold just keep going here? I mean, I know we want to hold it in the strategy longer term, but what are your thoughts?
Yeah, there's been, of course, a lot of debate. I always like to say, let's zoom out and think about where we've come from. And I think this latest blip was healthy. The rise in gold prices over the last several months has been parabolic. We knew that there's no way that can persist without some form of volatility along the way. It's similar to, investing in the equity market. The reason you get compensated is because you're willing to take risk. You're willing to experience volatility. And when asset prices are rising this rapidly by this much, you just know as a prudent investor, there will be hiccups along the way. And so I guess the question becomes, is this the time to sell? Have we hit the top? I believe there's still a lot of continued tailwinds that can propel gold higher from here. And I don't just mean the retail trading. I would say in the last couple months, retail traders have been, it's almost like the meme stock craze where everybody starts piling in, having FOMO, feeling like they've missed the run up. Partly that I think was maybe some larger investors taking gains the last couple weeks and some of the shakeout and understanding volatility is likely going to have to pause this run up in gold at some point. And so I think it was a little just bit of harvesting some gains and stashing those away. I think what's encouraging is that gold has kind of bounced off of that lower bound of that 4,000 level. So seeing that as a bit of kind of a bottom right now, where if we can remain above that from a technical perspective, I think gold has a chance to continue to move higher. We've also seen a lot of large banks and analysts and strategists increase their price targets from here. I think it was maybe Morgan Stanley or someone just came out and said 8,000 target by the end of next year. And so that also creates a bit of momentum. And so I think, just to say this is all fundamentally driven or driven by people that have concerns on debasement, declining purchasing power of the US dollar. It's a bit of that, but I also think the momentum and the excitement around everybody piling in. I would say something that was super interesting that I saw in the last couple of days here, I won't take credit for this, but I reposted it on X, was as of July 1st this summer, Basel III, which if you guys forget what Basel III is, that came about in the post-GFC environment to help increase regulatory considerations within the banking sphere. And up until July 1st, gold as an asset held by banks was considered a tier 3 asset, which means it's volatile. It gets marked differently. They have to, they can't, if you're holding $100 in gold from a regulatory perspective, let's just say, roughly that only counts as maybe $50. With this change as of July 1st this summer, from a banking regulatory perspective, gold is now considered a high quality liquid asset or a tier 1 asset. And so the full value on the balance sheet of banks is considered capital pledged. And so we go back 12 months, a lot of the tailwinds that are now why we're at, gold above 4,000 today is because of foreign central bank buying. And so I think this recent change from a regulatory perspective, allowing gold to sit on their balance sheets and be a high quality liquid asset, will just further incentivize a lot of these banks to continue to hold gold. It's almost viewed in the same way that cash is or high quality bonds are today. So I think that's also another important tailwind that can pull gold higher from here.
Yeah, absolutely. How do you, I guess two follow-ups there, creating the income on that, because I think it's yielding a little over 5.5%, where if somebody has a bar of gold under their mattress, obviously they get no yield, right? There's also right now in the marketplace a lot of cryptocurrencies that are also producing products and ETFs with yield on it. I think you guys even have one.
Yep.
How do you generate that yield on the gold, YGLD ETF? And then does your strategy team ever consider, if Bitcoin's kind of softened a little bit, but if you have that as a strategy in your bag, do you ever consider switching, in our portfolio to something like that if you have a yielding strategy in a cryptocurrency?
Yeah, so one correction, actually, the Y gold or the levered gold with the income overlay is actually yielding in excess of 9% right now, which is incredible.
Wow.
We've increased some of the distributions there, given some of the gains. But to answer your question, how are we generating income on gold? And that is one of the common pitfalls of gold, is that it doesn't give you any yield or income. It's just kind of it's a block of metal, right?
Mm-hmm.
And so we sought to find a better way that investors can hold this and get more out of their gold exposure. So again, just to be clear, we're levering gold through futures. So we're giving investors 1.5 times exposure to gold. And then the way that we generate the income is by selling put options on diversified indexes such as the NASDAQ, S&P, the Russell 2000, as well as selling put options on gold itself. And so you can think about this as like an equity income overlay. And by selling the put option, you earn the premium, and then you hope that those assets continue to move higher, and then you just get to collect the premium and there's no downside. Obviously, there's no such thing as free lunch. So at certain times, if you are selling put options and markets decline, that can move against you. But we've been in this environment again of lower volatility for the last several months. And so that income overlay has delivered attractive returns that help boost the yield and distribution rate on some of these strategies. And then the other part of your question was the other tools in our kit. You are correct. We do have a crypto strategy, which is centric to Bitcoin, that has a bit of a trend model and also has our income overlay on that. That is a tool that we have that we can, of course, introduce to the portfolio at large. I think, of course, thinking about a lot of the allocators to the strategy coming from the crypto space, a lot of the assumption is that they're achieving their crypto exposure directly or through other vehicles, and so we did not want to be redundant. Then that's why we kind of chose the gold exposure over crypto. But I would say it also tees up the question of what other strategies do we have on our shelf that can be additive to T12 today or in the future. We're constantly evaluating this. This is actively managed. We're meeting with, as an investment committee here at Simplify, on a monthly basis, as well as having conversations ad hoc. A strategy I think that's really interesting that we've adopted in many of our model portfolios across Simplify's business, that could be a strong candidate later this year for inclusion in T12 would be our currency strategy. And that is a strategy that we just launched earlier in 2025, has had exceptionally strong performance, even outperforming the S&P 500. And that is a strategy which is driven by the carry or yield of currencies in both emerging market and developed market regions. And so because of that carry or yield that we're harvesting, this strategy is moving towards monthly distributions and is targeting a high single-digit distribution yield. And so this starts to become attractive as a diversifier and as a source of income in T12. And so we will likely look to incorporate this in the next month or two as we think about additional ways to diversify.
Yeah, I think just hearing you talk through that, thinking of anybody who's listening to this that's sitting on some sort of 60-40 portfolio or whatever that is, yielding something less than half of what we're yielding here, and knowing that you have the ability to shift like that and protect and add alpha in certain places is well, it's proven out this quarter, and it's very important, I think, for people to hear. Same kind of question on the SPUC, the upside convexity strategy. And I don't want to quote the yield that's on my page here because I may be off on it too. Can you speak to that one a little bit and how because it's not just buying calls, correct? I mean, you're also doing some selling as well.
Yeah, so SPUC is really meant to be incorporated, or its objective within this model is to provide investors an avenue for upside participation when equity markets are ripping higher. And so that's been a really strong tailwind for the model in just the last couple months here as markets have continued to melt higher. And so just to be clear, we think about this fund, of course, holistically at the top level because there's numerous building blocks underneath. And so each of these individual building blocks has its own core objective, which in combination together provides the target core objective of the strategy. So SPUC is an example where we wanted to, and it's a smaller allocation, it's about 10% of the total portfolio. Again, provide an avenue for upside participation in equity markets. The objective of SPUC is less about that target 12. We have plenty of other solutions or funds within T12 that are focused on that distribution and yield target. And so SPUC has its own objectives, which is just enhancing the total return potential of T12.
Okay, no, that makes sense. What about, obviously we love all the positives and everything that we're at today. What about challenges? What about something you wish you would have done differently this quarter?
Well, no regrets here. I'm kidding, of course. But I would remind everyone, as you know, anytime we're talking about investing in markets broadly, there is no such thing as free lunch. The one exception, of course, is diversification. As Harry Markowitz has always famously said, the best way to build a strong, resilient portfolio is to diversify your risk. So that is something we absolutely adopt philosophically as it relates to T12. But there will be bumps along the road to earn. And I think just at the kickoff here, Manish, you had mentioned how extraordinary the 12% distribution target really is. There are a lot of strategies or funds that have come to market in the last year or two that have these high target distribution yields. But to build a resilient, diversified solution that still is able to target that, I think is something that's really special. With that being said, again, each of these underlying building blocks at times will hit their own roadblocks. An example of that might be in the last month here, with just kind of some of the digestion of markets at large and coming off a quarter of such extreme low volatility in markets. What we saw, of course, was some of the news on China tariffs about 2 weeks ago, and then just looking at kind of the broader portfolio insurance space, which is really selling or buying volatility. We have a strategy which is it is the highest yielding strategy within T12. The ticker on that is SVOL. It's our volatility premium strategy. So we achieve currently in excess of 19% distribution yield on SVOL through selling futures on VIX, which is the implied volatility of the S&P 500. And so by doing that, there will be times when volatility is going to spike. And since we are selling that, you think about it from an insurance perspective, we're going to experience losses. And so the last couple weeks here, SVOL, although it still maintains its target 19 plus distribution rate, and when I say target, just the current distribution rate that will fluctuate over time. But its core objective is to kick off high yield. It's continued to do that. But from a stability perspective, there has been more volatility in the NAV of that underlying fund. So that's an example where we wouldn't have done anything differently. But all of the building blocks are not all going to work perfectly at all given times. And that's, again, the beauty of diversification.
Yeah,
Right.
absolutely.
So
yeah, go ahead.
just looking forward, right? I mean, as we think about the Q4, where the market is today, and just sort of nobody has a crystal ball, because if you did, that would be amazing. How are you seeing the markets develop given the global instability, perhaps on any given week? We live by the tweet, we die by the tweet. How do you sort of really see that playing out in terms of the tariffs, in terms of the market conditions? Clearly, gold is a big theme across the board on crypto Twitter. General thoughts on that front?
Yeah, I would say, historically speaking, from a seasonality perspective, fourth quarter is one of the strongest quarters from an investment market perspective for returns. So with that kind of in our toolkit here, the biggest risk, of course, is the tweets, the information that hits us on a Friday at 4 o'clock or over the weekend, and markets freak out. I think what we've seen, though, is markets shake that off pretty quickly. Over the next couple months, I think there's plenty of tailwinds that will continue to push equity markets higher, continue to offer opportunities across asset classes. Was it next week? Is it this week or next week? I'm confused where we're at. The Fed is, with almost 100% certainty expected to cut rates. That's already baked into markets. So provided they don't do anything crazy, I think markets will quickly move past that and continue to move higher. It's injecting more policy support into markets, which markets will react favorably. So I think the other risk too is we've been in this government shutdown, and we have not had as much access to economic data as we might otherwise require or be used to in the last couple months. And so I think as soon as that we move past this government shutdown and we start to get data, I think markets will go back to slicing and dicing every single data point that comes to market and trying to understand where we are from the health of the economy perspective. But overarching, I feel pretty comfortable with where we're at. I think that markets don't have any major cracks right now. And all things considered, seasonally speaking, this tends to be a strong quarter. Earnings are starting to come out as well. There'll be some hiccups with earnings, of course, but from a perspective of what it means for T12, I don't expect any wide sweeping changes to the allocations here. We, again, have an active management process, but that does not mean that we are timing markets or we're making massive tactical bets or calls based on where we think markets are headed. We are humble enough to know that we cannot outsmart the market. So how do we just still focus on being diversified, hitting that 12% target and trying to mitigate wherever possible.
Brilliant. Well, listen, I mean, we certainly appreciate the effort that kind of goes into managing this portfolio. I would ask Nate, do you have any last question for Paisley? Otherwise we're coming on the mark.
Yeah, I know we just had a couple of minutes here, Paisley, but I'm always curious. All your strategies, you guys are very creative, and you've grown, I think, on the derivative exposure and just being so creative. What anything coming down the pipe that you're excited about, or strategies that are being talked about that are coming to market?
Yeah, so Simplify is always looking for new ways to bring innovative solutions to our clients. And I would say the one thing that perhaps is unique that I always like to stress is our goal is to bring tools to market so our clients can express their views. It's not to push our views or make massive macro calls. So that's why you see a lot of really innovative strategies, whether it's strategies that are focused on duration positioning. We have strategies that have a negative 40-year duration and strategies that have a positive 40-year duration, which sounds crazy. But for our institutional caliber investors that are looking to pinpoint and be tactical and have levers they can pull to be capital efficient, these are really important trading tools. And as you mentioned, we have our suite of equity income strategies. Something I think is really interesting to note in the last, it was, I guess, in April, so about 6 months ago, we launched our response to the modern approach to structured notes. And structured notes have been around for decades and continue to be a very large part of many advisor portfolios because of the attractiveness of the stability of them and the high levels of yield that they provide. And so 2 of those strategies are in T12. The tickers on those are SBAR and XV. And so those provide downside protection in the form of writing barrier options, but then also kick off anywhere from 12 to 15% distribution. And so those are 2 really innovative, unique strategies that, again, now have a 6-month track record. We've been able to gather quite a bit of AUM, and those are really resonating as a modern approach that's revolutionizing really how advisors think about the use of structured notes in the portfolio.
Amazing. Well, listen, we certainly appreciate your time, Paisley. Keep up the great work. And I know we have some additional products that we're going to be launching with Simplify Asset Management. Tokenization of some of the work that's taking shape. We'll be making that public soon. So thank you all for joining. Paisley, thank you.
Yeah, thanks, guys. Always a pleasure.
Thanks, everybody.